Guys, welcome back to our series on Finance Made Simple. Second video, we're talking about how much deposit you need. How much do you have to put in for your next property? Now, we've been through LVR. We looked at a scenario where you're buying property at 500, you've got a $400,000 loan, you've got an 80% LVR. Let's look at how much costs. How do you actually work out how much you need to put in? Keeping the same ratio, okay? Thinking about things as a ratio, same rule of thumb. If we're looking at it as a percentage, 500 in this case is going to represent 100%. That's the value of the asset. Okay, we allow 5% as a good rule of thumb for costs. That's going to cover stamp duties, legal fees, application fees to the bank, all those sort of bits and pieces you've got to pay when you buy a property. 2% for LMI is a good guide if you need to borrow 90% of the value. So, instead of 80%, 400, if you need to borrow 450 on a 500 asset, that would be roughly 2% in LMI. It's a sliding scale, it does vary case by case, the size of the loan and a few other factors. To get an accurate, we can do that at a later point. In this example, you have 107% worth of costs, including the value of the asset. If we're going to get financed at 90%, then we're left with a contribution of 17%. We know how much we're putting into this deal, and then we're going to leverage other people's money. We're going to use the bank to finance the balance of it. We're going to put 17 in. We're going to buy an asset worth 500. The bank's going to put in this case, 90%. How much does your 17 represent? Work out 70% of the value of the asset. In this case, $85,000. That's as simple as it is. So stay tuned for more videos in our Finance Made Simple series.